Ladies and gentlemen, good day and welcome to Syrma SGS Technology Q2FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital. Thank you and over to you, ma'am.
Yeah, thanks. Good morning, everyone. On behalf of DAM Capital, I welcome you to the Q2FY26 earnings call of Syrma SGS Technology Limited. We have the entire management of the company with us. At this point, I'll hand over the floor to Nikhil Gupta, Head of Investor Relations of Syrma, to take the proceedings forward. Over to you, Nikhil.
Thank you, Bhumika. Hi, everyone. Very good morning to you all. Welcome to Syrma SGS second quarter financial year 2026 earnings call. We have with us today Mr. J.S. Gujral, Managing Director, Mr. Jayesh Doshi, Director, Mr. Satyendra Singh, Chief Executive Officer, and Mr. Vijay Agrawal, Chief Financial Officer, Syrma SGS, to discuss the performance of the company during the second quarter of the financial year 2026, followed by a detailed question and answer session. During this call, certain statements that will be made are forward-looking, which involve several risks, uncertainties, assumptions, and other factors that can cause results to differ materially from those in such forward-looking statements. We request you to kindly refer to the disclaimer statements as presented in the earnings release for the same. With this, I now hand over the call to Mr. J.S. Gujral, Managing Director, for his opening remarks on the performance. Thank you.
Good morning, ladies and gentlemen. A very warm welcome to all of you. Q2 has been a quarter full of activities and a lot of positivity. While we achieved record EBITDA, profit margins, turnovers, what was more significant in this quarter is the slew of tie-ups and joint ventures which we have executed. And I think these joint ventures and tie-ups lay the foundation for the sustained future growth in the years to come. While the figures for the quarter and the half year will be explained by Vijay in detail, I would like to dwell on the macro level scenario. As we have been always communicating that we would be going in for inorganic expansions in verticals where we were not present. And defense has always been highlighted as one of the verticals where we had a very minimal presence. Now, we are very happy to announce that we have acquired 60% stake in Alcom, which is almost a 50-year-old company, was established in 78, and provides navigation, surveillance, communication, and such solutions to the armed forces, paramilitary, and private sector. It has a very good reputation in the market and has a top line of about 200 crores with a profit EBITDA margin of about 25-24%. And we expect that this acquisition would in the coming years show a very good growth and will be margin accretive to the company. The second tie-up which we made, as we announced earlier, was a joint venture with Elemaster of Italy. And Elemaster is again a very old company servicing clients across the world. And the venture which we are setting up in India would, in the initial phase, cater to the demand of the Indian market. But once we have established our credibility in terms of delivery, quality, and other things, it opens up doors for integrating to the global supply chain of Elemaster. This may not happen in 26-27, but in the years to come, I think this will form a very substantial base and growth strategy for the Elemaster joint venture. The PCB projects which we are setting up, since our last call, we have got the ESPMS approval from the Government of India. We were the first among the 3 companies. And the project has already been approved by the Andhra Pradesh government, and we should be breaking ground for construction in the coming months, somewhere in December. And we hope that by December 26, we should be able to start out our trial production. The response, the sort of feedback which we have got from the customers on the PCB, to say the least, has been very, very encouraging. And all major companies are looking at indigenizing their supply chain for the PCB. So we are very confident that going forward, this project and this sort of diversification would help us to not only expand our revenues, but also be margin accretive. The fourth tie-up which we made was acquisition of K Solar along with Premier. It's a decade or 15-year-old company into solar inverters, does a revenue of about 300 odd crores. And the solar market is growing. So Syrma and K Solar have tied up to manufacture these inverters. These will be manufactured at our Pune facility, and we expect a good revenue traction coming out of this in the coming year. The product portfolio, which currently is sort of tilted towards the rooftop solar, would be diversified to bring in the grid inverters, the micro inverters, and the like. So we are very confident and gung-ho about this particular venture. So all put in, the four ventures which we have sort of entered into lay the foundation for a very strong growth trajectory in the years to come. For the current quarter, we have onboarded 8 major customers which have a potential of giving revenues of $100 million in the next year. In addition to that, we have now started focusing on long-term framework contracts with the customers, and we have entered into one such contract with one of our major customers, which has the potential of giving a revenue of about $250 million over a 2-3 year period. Going forward, we would be strategizing to sustain this momentum of long-term contracts so that the growth visibility for the future becomes more clearer. We are very, very confident that the results achieved thus far would be sustained in the coming quarters, and next year would see an incremental jump in revenues and EBITDA margins. I now hand over to Bijay to take you through with the detailed financials. Thank you.
Thank you, Mr. Gujral. Good morning, everyone. I'll now quickly take you through the brief summary of financial performance for the quarter and half year ended September 2025. I can start with the consolidated total revenue. For the half year, we did approximately 2,109 crore rupees of total revenue. And for the quarter ending September 2025, we did 1,146 crores of revenue, which is a growth of 37% on a year-on-year basis. This robust growth for the period is contributed by higher growth in auto, industrial, and IT segments. Our export revenue for the quarter is approximately 270 crores, which is again grown by 40% on a year-on-year basis. And for the half year, it is around 502 crores, which is again a 35% growth on a year-on-year basis. Our ODM revenue for the quarter and for the half year is around 13%. On the customer concentration, my top 10 customer contributes near about 56-57% of my total revenue, and top 20 customers near about 72%. When we see this overall business mix, wherein the industrial sector contributed 26% as against 21% in H1 of last year, so it has increased as a business mix here in this current year. Similarly, auto has also contributed 24% of my total business as against 21% of last year. And consumer sector has contributed around 32% in H1 as anticipated and previously communicated that we will bring it down below 35%. This overall improvement in the business mix has helped in improving the gross margin by about 500 bps in H1 as compared to the similar period of the previous year. Our gross margin for the quarter is about 23.8%, and for the half year it is 24.3% with a healthy expansion of 500 bps here. My operating EBITDA for the quarter stood at healthy around 116 crores, which is a 56% growth on year-on-year basis, and again 10.1% of the EBITDA margin, operating EBITDA margin. Similarly, for the half year, my total overall operating EBITDA is 211 crore, which is again 10.1% of our EBITDA margin, and with a growth of 64% on a year-on-year basis. Same way, when we see PBT for the quarter is around 90 crore rupees, which is again 7.8% of the PBT margin, and for the half year it is 156.6 crore, which is a PBT margin of 7.4%. Our PAT for the quarter is 66.3 crores with a PAT margin of 5.7%. And for the half year, it is around 116 crores with a PAT margin of 5.5%. With this, when we see the overall order book position as on September end is approximately 5,800 crores, which comprises maximum from auto segment, which is around 35%. Both consumer segment and industrial segment contributes near about 25% in the order book, open order book currently. Healthcare is about 6 to 7%, and balance is from IT and railway sector. Coming to our net working capital days position, as on September end, my overall net working capital days investment is around 73 days, which is 4 days higher on a year-on-year basis. We again continue to make efforts to bring it down to below 65 days, and we are confident of bringing down by another 5 to 7 days in the next 2 to 3 quarters. Moving to our debt and treasury position, we have a total gross debt of around 282 crores as on September end. And on treasury, we hold a healthy balance of around 758 crores as on September end. With this, we have a net cash position of 477 crores. Coming to operating cash flow, my operating cash flow for the half year is negative 115 crores, and this is mainly because of incremental investment into the working capital. We are carrying higher inventory by almost 100 crore rupees, mainly because of anticipation of supply chain constraints around rare earth and some bit of volume push out related to the US tariffs, which we see gradually in the second half, we should be able to liquidate the same quickly. With this, we are confident of achieving a positive cash flow of around 25 to 30% for the full year, as targeted and communicated previously. Coming to CapEx for the half year, we had spent around 45 crores during the H1 of this year, and we expect to invest around 60 to 100 crores, including my investments towards the PCB business also in the balance of the year. My asset turn currently is about 5.3 times, and the ROC for the period is approximately 15% when we adjust it for the goodwill and surplus IPO and QIP money which we have recently raised. Coming to the acquisition of Elcom and Navicom together, which Mr. Gujral has already explained, we expect this to be consolidated in our overall financials in Q4. That's what we are targeting. The company, together with Navicom, is currently doing about 205 crores of revenue with a healthy EBITDA margin of 25-26% and PAT margin of near about 15%. With this, we continue to focus on high-margin business verticals, expanding our portfolio base, improving our operational efficiencies, and the overall cash flow improvement thereby. Thank you very much. And now I will hand over to Mr. Satendra, our CEO, to take on the business strategy side.
Thank you, Vijay, and thank you, Mr. Gujral. As always, I'd like to start my remarks by thanking the customers whose trust over decades has brought us here, and we would continue to do everything in our part to continue to delight them over next decades. We had a stellar quarter with organic growth of 37% and almost 53% growth in EBITDA, in addition to the inorganic moves, which Mr. Gujral already alluded to. This is possible only with the wholehearted support and efforts of all our team of almost 10,000 colleagues in the plants and the offices. So I would definitely like to thank them once again for all their efforts to delight our customers and the investors as well. There are three elements of excellence: people, strategy, and execution. We continue to focus on all of them, and which is what is resulting into the results which we reported just now. On people side, we continue to augment the leadership capabilities, and we brought in a new leader on the digital and information systems. Strategy remains unchanged, and we have always said that we will focus on a certain strategic segment. We will look at growth across geographies, and we will continue to build capability for the future. I'm encouraged with the results which we reported today, and very excited and very optimistic about Syrma SGS as a family here, as well as the wider electronics industry. Thank you very much, and I'll turn it over to Nikhil and him to take it forward.
Thank you, Subedar. Operator, back to you. We can get into the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Hi, thank you. So a couple of questions. Firstly, given how 2Q has, or let's say 1H has panned out, are we sticking to the 30-35% revenue guidance from an organic perspective for the full year? And also, if you can update your EBITDA margin guidance, given that, we have done extremely well in the first half.
Bhavik, thank you. I request if you can repeat your question. I think there was some problem with voice. Yeah.
So the question was that given how 1H has panned out so far, are we sticking to the 30-35% top line guidance for FY26? And also, if you can update the EBITDA margin guide, given 1H has been extremely strong.
Okay. See, on the turnovers, we stand by 30% approximately growth, give or take a couple of percentage points here or there. On EBITDA, we have guided 8.5 to 9%, and seeing the performance for the first half year, which is now 10%, we are very confident that we'll be able to exceed the guidance which we had shared with the street last quarter. Whether it is 9.5, 9.4, 9.6, I think that we'll leave it at that. But we'll be positively giving a bit of north of what we had guided last quarter for the full year as a whole.
Okay, got it. That's helpful. The second question is on the ECMS approval, since you have received it now. How should we think about the capex outlay of 8.5 billion rupees over the next 12 months? Is this something which will start right away, or will it be coming over phases, over the next 12 months?
Okay. No, we got the ECMS approval. We were the first list, and the plans are on target. So the land has now been allotted to us. So the formalities of getting the land registered are being done. Architects have already been finalized. Tenders for civil and building and other things are being floated or have been floated in some cases. And we expect to break the ground for construction sometime next month. The moment the property is registered in Ronin, that takes about a week, 10 days. That's the government process. But the plans are on track from our side. We are all ready. And the layouts have been finalized, the machine vendors are being finalized. So these things will go on parallelly, and we are confident that we would be able to stick to the deadline of starting trial production somewhere around December 26 or fourth quarter of 26-27. So there is no change on that.
Okay, thank you.
Thank you. The next question is from the line of Sameet Sinha from Macquarie. Please go ahead.
Yes, thank you. A couple of questions here. So, we're just talking about revenue increase sequentially, but gross margin declines. My guess is some sort of a mix issue or something did not, one of the high margin verticals did not go as per plan. If you can address that, then also talk about kind of EBITDA margin which increased sequentially. Obviously saw some operating leverage. Was there anything one time there, or is that sustainable? And then I have a couple of follow-up questions.
So if you are sequentially comparing Q2 gross margin versus Q1 gross margin, there is a slight difference, but that is because of the business mix. Because in Q2, IT business has taken a larger portion here, about 5% of my total business. That is where we see there is a slight bit of mix change and some impact of 0.8% on the overall gross margin. But overall EBITDA margin-wise, because that comes at a very low cost on the low operating cost, so that is why overall EBITDA margin further remains same, Q1 versus Q2.
Got it.
So on a annualized basis, we sort of, there could be marginal variations quarter on quarter, and as we always been saying that we don't look at businesses on quarter basis rather than yearly and long term. We are very confident that what we have guided will be able to deliver a performance better than that.
Got it. The second question is regarding these long-term contracts that you're signing. Do you have to provide some sort of incentives for these customers to get into these long-term contracts, maybe heavier discounting? I mean, it's obviously important to have the long-term visibility, which is at least we would love, but just wanted to kind of get your thoughts there. Secondly, you mentioned some sort of deferments because of tariffs. If you can clarify that as well.
See, there's no discount for things to be given on the long-term framework contracts. It's just that you have to build up capacity, you have to commit capacity. So with big customers, it's a mutual two-way street. When we commit capacities and capital, we would like to have a commitment from their side on what businesses they would give to us. So it's not linked to any discounts. On the tariff part, I think the last ball is yet to be balled. There is still a lot of sort of confusion, lack of clarity, and that has impacted us slightly. Decision making and taking only need-based supplies. But I think from whatever we hear in the press, for whatever it is worth, I think the worst is behind us, and in the coming few weeks or a month or so, I'm confident before Christmas we should have a deal on the table, and I think that will help us to strategize for the future growth. As we have communicated, USA accounts for about 5-6% of my total revenue, the exports to USA in the current year. But on the longer sort of time frame, USA would be a key player which would help us increase our export presence. And I think once the clarity of the tariff emerges, we have more clarity on our future plans, which is next year and the year beyond.
Got it. Thank you very much.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Yeah. Hi, good morning. Thanks as always for your time. A couple of questions. One, in Q2, we've seen the slowdown on the industrial segment sales to, I think, about 9-10%. If you could just help us understand what's driving that slowdown and, more importantly, how do you see sales for the full year?
Again, we are mindful of Q1, Q things, but on an annualized basis, we are very confident on our industrial portfolio, and which has grown very decently in the half year, about 30% in the half year, and which is, I think, a robust growth despite the American tariffs and other things. So we believe that industrial portfolio would continue to be a mainstay of our growth and profitability. And the contracts which I was alluding to that we had entered, the orders which we have got from new customers, they are spread across industrial vertical also in the power management, power distribution, and the like.
Understood. Okay.
So we don't look at quarter on quarter. We are mindful, but strategy is based on the long term.
Fair. Okay. So we're broadly on track for the full year. Okay, fair. And similarly on the IT railway segment, we've seen a very strong growth. I think this quarter, I think about 160 odd crores of sales. Is there something? Is there some orders that are now getting executed? Can we expect this quarterly run rate to sustain? Just some color there, please.
See, the IT products are essentially laptops and other things. So one of the major clients with which we are tied up, it has shown a very good growth in the last 6 months, and we expect that the growth would continue, whether it's at the same pace, but we believe that IT would continue to grow at a decent pace, and with onboarding of another client, Dynabook, I think we get a broader base of additional customer to grow the revenue.
Got that. Okay. And just some last one on this acquisition that we've done and announced on Elcom. If you could just spend maybe a minute, what does it bring to the table for you? On the defense electronics side, how do you see this business kind of shaping up over the next 2-3 years? What are the synergies you're talking about? Just if you could spend some time on this, please.
We have all the time been sharing with the street that defense is one of our priority areas for growth, where we had a minimal presence. Mm-hmm. And in defense, the approvals and other things take a long time. It is a long gestation period. Mm-hmm. So we had sort of indicated to the street that we would be going in for an inorganic route to enter the defense sector. Yeah. Now, this company is almost a 5-decade-old company established in 1978, so it's about a 47 years old company, and has been in this business and is supplying navigation, communication, display, surveillance, safety, helideck monitoring, alarm monitoring, a lot of solutions to the armed forces, especially Navy and paramilitary forces. Mm-hmm. So again, we sort of get a platform on which to build the business. Right. Defense business by nature is lumpy, so it is sort of loaded always towards the second half of the year. But we believe and we are confident that we would be able to grow this business from the current level of about 200 crores to maybe 350 crores in the years to come. And these businesses are comparatively high margin business with a higher sort of working capital cycle also. So these two go in tandem. So I think we are very excited about this acquisition, and it gives us an opportunity to add in other portfolio and skill sets as we go along to widen the product offerings to the defense forces.
Got that. Okay. And if I may just squeeze in one more on this long-term agreements, you said these could, add close to $300 million over 2-3 years on top line. I don't know if it's too early for the 27 kind of guidance, but can we expect a higher growth rate than the 30% we've been guiding for 26 with these long-term agreements kind of coming through? Is that how directionally we should be thinking about it?
I think based on whatever figures we have got today and the budget and the things for the next year are being finalized, we are very confident that we should be able to give a better growth trajectory in the coming years, starting 26-27. Under normal circumstances and the tariff condition gets sort of clarified and all those things, we're confident that the growth rate would be of a higher trajectory than what we would achieve in 25-26.
Okay, great. Got that. Great. Thank you so much and best of luck.
Thank you. The next question is from the line of Anupam Goswami from SUD Life. Please go ahead.
Hi, sir. You're not audible.
Hello. Anupam, you have to be slightly louder, please.
Yeah.
Hello. Hi, sir.
That's good.
Hi, sir. Congratulations on the good set of numbers. So my first question if you can give us a little picture on the X of acquisition, Syrma, where does the growth lies in which segment, and what are the TAM are we looking for, and the growth avenues for Syrma itself, apart from the acquisitions that we have done?
Okay. So you see, defense acquisition is a new vertical. PCB is a backward integration, a new vertical. Master is into railway, so it's part and parcel of our existing portfolio, and so is the renewable energy. Now, if I was to only talk of excluding the defense and the PCB venture, we still believe that we are in a position to deliver superior growth rates in the coming years than what we have achieved this year or thus far. I hope that clarifies the thing. And this would primarily be driven by industrial, automotive, including EV, renewable. The solar business would grow. It would add a decent amount of top line. It's a competitive landscape and a decent margin. Exports would continue to be the cornerstone for our growth in the coming years. Long-term sustenance of any EMS company cannot come without exports. And we are well positioned to cater to this market. And in the first half of the year, our exports have grown by almost like 36%. And we are by and large, we have already achieved about 500 plus crores of exports, and we are guided about 1,000 crores of exports in the current year. We are on track to achieve that. The defense and the PCB, the defense revenues will kick in 27, 28. No, 26, 27, sorry. The PCB revenues would kick in 27, 28. So whatever guidance we are giving today of a superior growth rate is without defense and without PCB.
Right. So you mentioned about auto and industrial segment to take lead in our growth. Where do you see the growth coming from in terms of the pipeline of new customers or new products? How is that pipeline shaping up and inquiries?
Automotive growth would come in from the automotive sector, including the EV, as the adoption of EV becomes bigger. The per unit electronic content in EV is bigger, and that would increase the pie of the business available. In industrial segment, the growth would come in from the metering, with a lot of data centers coming into the country, the requirement of power management units, power electronics in the contracts, which I was referring to, essentially cater to those requirements. Yeah, and so
in addition, I think industrial is a segment which we're addressing not only for India but also outside India customers. So some of the global customers, one Mr. Gujral referred to today, and there are more in the works, are for global requirements. So our growth in industrial will come across geographies. And automotive growth will have two pieces. One is EV, which Mr. Gujral already spoke, and second is the holistic growth on the electronics content in the traditional vehicles as well. So there are new things which are being added, like safety systems or ADAS requirements. So those are going to fuel the growth of electronics absorption into traditional automotive vehicles as well.
Got it, sir. Thank you. I'll join back.
Thank you. The next question is from the line of Naushad Chaudhary from Aditya Birla Mutual Fund. Please go ahead.
Few clarification. First, if you can quantify what was the PLI incentives.
Your voice is not clear, sir. Can you speak a bit loudly? Your voice is not clear.
First, wanted to check if you can quantify what was the PLI incentive we booked in this quarter and what was and for the same quarter last year.
Okay. Vijay.
So PLI is something a part of normal income business is what we are accruing here. For the full year, generally we have already guided it should be in the range of around 20 to 25 crore rupees. And quarter specific numbers we are yet to check what is exactly there in that.
But it's in line with the revenue. You see, we had guided our consumer revenue, for example, that it will come down. So the consumer revenue of the PLI denominated business would be almost the same as the last year. And so we have guided about 24, 25 crores of PLI income for annualized basis. This is what was there last year on an annualized basis. So there is nothing abnormal, short or excess in the PLI.
And should it be equally spread in all 4 quarters, more or less, or should there be a lumpiness?
It could be marginally again, quarter-on-quarter business. If my consumer business picks up, for example, in the first quarter of last year, it was 54%. So it will be there, but I now believe we have passed that bump. So it should be by and large. I'm not saying it will be secular, but by and large it should be evenly spread over the 4 quarters, by and large.
And how much revenue we booked from smart meters in this quarter?
Ladies and gentlemen, please hold. We seem to have lost the connection with the management. Ladies and gentlemen, we have the management back online with us. Sir, you may proceed.
Yeah, I was asking on a smart meter, how much revenue we did in this quarter?
Just hold on, I think Vijay will pull out the details, but I think we did about 4 million units of smart metering.
We did approximately 50 crores in this quarter.
Okay. If I remember it correctly, we had a target of roughly 250 to 300 crore rupees from this piece of segment. Are we on track to achieve our full year guidance on smart meter?
We are on full track. These are quarter-on-quarter variations would always be there. So broadly, we were targeting near about 300 crore plus from the smart metering business. That's where we are already there on that track. We have also onboarded one more new customer, large customer on the smart metering side. The respective revenue from that customer should now reflect in the H2 also, additionally.
Okay. All right, sir. Thank you. All the best.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity and a big congratulations for the team for an all-round beat. So my question is on the PCB manufacturing. I know Gujral sir has talked a lot about the timelines and the capex, etc. But just on the revenue front, should we assume sort of a 1x asset turnover to the capex? And what would be the kind of steady state annual revenues that you expect from PCB manufacturing to accrue to your overall P&L from FY29 onwards?
The PCB industry typically works at 1.2 of the gross fixed assets, 1.5 max. So if we are targeting an investment of about 1,500 crores, so the max revenues which we can expect from the business would be 2,500 crores.
Understood. So, and sort of, I know it's a bit too early, but from the point of view of usage of your production, would you be targeting customers domestically or, to the exports? And sort of which segment will you be targeting on?
Okay. See, this is something very, very exciting for us. And the number of calls which our teams have been receiving from big companies in India who want to indigenize their supply chain of the PCB. And I'm talking of big multi-billion-dollar groups who are showing interest that when is the plant going on stream. And these groups have usage in automotive, industrial, healthcare, all around. So in the short term, the way we are planning is that we would be catering to the domestic market, and it has a certain time approval, the process approval, the product approvals take place. But going forward, when I say going forward is beyond 28, we would be looking at the export markets also. The usage would be automotive, consumer, industrial, medtech, telecom.
Got it. So very clear. And just one last question. You mentioned total capex of about 1,500 crores, that's 15 billion. Of this, I think FY26 we are expecting not more than 2,000 million, that's 200 crores. How should we look at the capex over the coming years, say FY27 or 28?
Vijay will deal in detail on this.
So FY26 may not be 200 crore only for PCB. It will be even much lesser. Maybe when the capex is slightly loaded in FY27. So what we are anticipating between FY26, 27, 28 together is what we will be spending around 700 to 800 crore together.
Got it, sir. Very clear, and all the best to the team.
Thank you.
Thank you. The next question is from the line of Praveen from PL Capital. Please go ahead.
Yeah, thank you for opportunity. Sir, my first question is related to receivables. In this quarter or in the first half, if I look at, your receivable has increased significantly. So, will that going forward in a year going to normalize?
See, I wish everything would be normal all the quarters, but on an annualized basis, that was on a lighter vein. This is a work in progress, so clearly we have sort of exceeded the target what we had set to ourselves for working capital allocation or utilization. We are very confident that by the year end, as Vijay had alluded in his commentary, that we would be able to bring down the net working capital to below 65 days, and receivables are a big chunk of that. So we're very confident in all these big companies, and you can see if a 200 crore payment gets delayed by 5 days, your month-end thing goes for a toss. But on an overall basis, I think we are on track. This is a work in progress. We should be able to come down to the levels which we had indicated of 65 or below 65 days in the net working capital.
Also, receivables and payables are going in tandem together. So there is an increase in receivables and simultaneously parallel increase in payable also. We are working on the overall net working capital basis to reduce it to the targeted level. That's what we are confident of bringing it down towards the year.
Okay. Next question is related to the acquisition and especially the Elecon, where we had seen that last 3 years the CAGR has been more than 20%. So do you see this business to grow more than that way forward? How your estimate is?
If we see the defense sector, it has really picked up steam only in the last 2-3 years. Before that, it used to have bumpy ride. We are very confident that we should be able to maintain the growth rate or slightly increase on it. And in the next 2 to 3 years, we should be able to do about 350.
Yes. Additionally, with Syrma synergy here together, we can even now target large site projects, tenders together with a partnership. So that's where we see the growth should be much deeper here onwards.
Okay. And last clarification on the order book. As you had mentioned about the 8 major customer of $100 million order or the one large contract, is any of them are a part of your order book right now?
See, the framework contracts which we talk of are not part of the order book. They are general next 2-3 years. We talk of order book, what we receive the orders and the delivery schedule from the customers. So these long-term contracts would reflect in the coming quarters as of 30th September because one of the contracts was entered into after the close of the year. After the close of the period, quarter.
Okay, got it, sir. Thank you.
Thank you. The next question is from the line of Vineet from Investec. Please go ahead.
Yeah. Good morning, sir. Just continuing the question of the previous participant, our working capital and within working capital, if I were to break it down, receivables have increased quite sharply, maybe 80% year over year versus 40% growth we've had in revenues. So what specifically led to such a high jump in receivables in particular?
Obviously, the collections have lagged the sort of sales. And to me, internally and to me personally, managing receivables is comparatively the easier part of the working capital cycle management than managing inventories. So some sense of satisfaction in an otherwise working capital abnormality or thing. We have been able to control the inventories well, and the task is cut out to control the receivables. And I am very confident that when we meet somewhere in January or whatever, when we announce the Q3 results, you will see a significant change in the receivables position. Yeah, Vijay.
Also, additionally, whatever businesses we do on a job work basis, so that is not fully reflecting into the revenues because the net job work amount or maybe net value addition is what is reflecting into the revenues, but the related full value receivables and payables are reflecting into the receivables and payables. That is also another point which is showing as an increase on a year-to-year basis here.
So more than the amount, we stick to the guidance that we'll be able to bring our net working capital to between 60 and 65 days. 60 is the desired state, but it would be anything between 60 and 65 days of the revenues. To me, that is more important than the absolute amount.
Okay. So is the understanding correct? The IT business which we are doing now is more on job work basis, which is driving, wherein the accounting is such that which is leading to higher receivables, and only job work related revenues are getting recorded in the P&L?
No, it is not related to IT business. With few of the select customers, wherever we are doing it, and maybe account that says wherein the receivable and payables are there to the account of customers, that's how we are accounting it for. So in those cases, receivables and payables are both are reflecting at the full value on the balance sheet, but the revenues are reflecting on the net value basis.
Understood. My second question is on the K-Solar bit. If you can give some idea about what proportion of their current revenues is coming from inverters. Solar rooftop is what I understand a larger proportion, where we cannot contribute much as of now, and only when inverters revenue pick up, that's where we'll contribute. So what is their proportion of inverter revenues as of today, and will the entire inverter sales which they'll do be manufactured by us and will be reflected in our top line?
K-Solar has been acquired 51% by Premier and 49% by Syrma SGS. So the consolidation will happen at the Premier end and not at the Syrma end. K-Solar is manufacturing inverters, primarily rooftop, and have capability of manufacturing other types of inverters also. So what we will be doing is manufacturing the entire module and assembly of inverter, and then billing it from K-Solar directly to the customers. So to my books, the accretion will be on the module assembly, which will be done in Syrma SGS.
Okay, so module assembly and inverter assembly related will be in our books, or it will be directly from K-Solar's books to customers?
K-Solar books to customers.
Okay, so we won't get any benefit on revenues. It will be a single line consolidation as far as K-Solar is.
We would get the benefit of value addition on the modules which we make in Syrma SGS. The revenues, inverter revenues will be accounted for in K-Solar books.
So the EMS, whatever is going for those inverters is what will be there as a revenue in Syrma books.
Understood. Perfect. That's helpful. Thank you, sir.
Thank you. The next question is from the line of Santosh from Avendus Spark. Please go ahead.
Hi, thanks for taking up my questions. So your margins have remained quite resilient this quarter, despite the overall revenue mix shifting towards some low margin businesses. So could you elaborate on what is driving this resilient margins? Is there any underlying efficiency or cost factors at play?
The margins are by and large, again, we don't look at margins quarter on quarter because if the product mix changes, the margins for a particular quarter would take a positive or negative variation. Once my business has now stabilized with almost all the verticals being at the levels at which they were budgeted to be, I personally don't see any significant variation in the gross material margins going forward. When my healthcare and exports pick up, there would be an uptick in the margins. So my gross material margins continue to be hovering around 24, 25, 24, 23, 24, 25%. And they were, when the consumer was very high, they were at about 15, 16%. So the consumer business having normalized, I think it will be around 23 to 25, 24 to 25, 26%. That would be the range of the gross material margin.
Thanks for the clarification. And my second question is, with the recent acquisitions and ongoing expansions, how are you thinking about scaling up your workforce? Should we expect to see some meaningful ramp-up in employee costs going forward?
See, the projects which are standalone, the PCB project would have its own workforce. So obviously, the cost will be absorbed by the PCB project. And on the EMS front, whatever growth we do, my direct cost of direct manufacturing costs would go up. The corporate costs, the indirect salaries would by and large, having now staffed almost all our positions except one or two, I don't think there will be a significant increase in that. It will be the normal increase in salary cost year on year. The direct manufacturing cost as the turnover ramps up would go in tandem.
Thanks, sir.
Thank you. The next question is from the line of Viprav Srivastava from Phillip Capital. Please go ahead.
Hi, sir. Congrats on a great set of numbers. So quickly on the JV with Shinyook, which you have signed for PCBs, wanted some clarity on the HDI side because as far as my understanding goes, Shinyook doesn't have much capability on HDI side. But what are your thoughts on that? Do they manufacture HDIs or it's only multi-layer as of now?
They manufacture multi-layers and HDIs also. So HDIs we will be starting to manufacture 27, 28 onwards. And we have the technology and I don't see a challenge in that.
Right, sir. And so we are yet to receive approval for that, right? In coming months we will receive approval for HDI also, right?
We have applied for it. That's a separate set of applications because the multi-layer PCB that only the PLI no capex incentive.
Right.
The HDI and other things have a capex incentive. So that set of applications is already with the government. So I think we'll see the approval of that in coming days. And our objective is very clear to cater to the high volume market of multi-layer PCBs, which is about 70 to 80% of the total PCB demand.
Right. Fair enough, sir. And sir, lastly, on the HDI side only, currently in India, obviously HDIs are mainly used for smartphones and automotive, which are relatively more complex to manufacture. So, do you have plans? Are we looking to onboard HDI clients? And secondly, also on the CCL side, what are the plans on that? Because we have read online that Syrma also wants to do CCL. So, do we have a client there? How are we planning to do CCL? So, yeah.
See, on the CCL, we are planning to put up a plant of CCL in the second phase. And it would be obviously, when I am putting up a 2.5 million square meter capacity for the PCBs, so that is a captive consumption which I'll be doing. In addition to that, I will be servicing the other PCB companies in the country.
Right. Fair enough, sir. Thanks a lot.
Thank you. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi, thank you for the opportunity. So on the PCB project front, as you highlighted, the first phase would be 800 crore capex. How about the second phase? When should we expect that to start? And secondly, how are the incentives on this state and central government and what lag they will flow in?
See, the state capital incentives are 50% of the amount spent. In the phase one, we will be spending approximately immediately 40 odd million and then 90 odd million total, which would cover my multi-layer line. The next 800 odd crores will be spent on CCL and HDI. The state incentives work on an annualized basis, so whatever I spend after I have spent, I get it approved and will be given in the subsequent year. So I believe that the state capital incentive should come back to us in the financial year 27-28 for the amount spent between now and March 27.
Okay, got it. And when you plan to spend the balance 800 crore for the phase 2, any thoughts right now on that?
See, that phase 2 would start somewhere towards end of 27, which will be the CCL part, followed by the HDA part. On the multi-layer line, we are putting up one multi-layer line which has a capacity of approximately 700,000 square meters per annum. The building and the facilities and the utilities are being put up for the complete three potential lines which we'll be putting up. The moment my first multi-layer line gets used to the extent of 50, 60, 70% is a time when we'll trigger the installation of the second. And when the second gets utilization to that extent, we'll trigger the installation of the third. So purely dependent upon demand, how would pace out the capex.
Understood. That is helpful. And central incentive would be 5% of the revenue for 6 years, right?
Yes, between 5 to 10% depending upon different layers. But yes, average would be somewhere around 5 to 6% what we are expecting conservatively.
Got it. Thank you. Thank you. That's it.
Thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to Mr. Gujral for closing comments.
Thank you, ladies and gentlemen, for sparing time for the Q2 earning call of Syrma SGS. To sum up, I think we have never been so gung-ho about the business with the government policies in sport and the states vying for attracting investments. I think the EMS industry is entering the second phase. The first phase was establishing itself, and I think going forward in the coming years, the electronic manufacturing industry would be one of the pillars of the growth of India. And we are fortunate, Syrma SGS is fortunate to be present at that cusp of time when this is seeing a huge demand. We are very, very confident of growth with profitability, with sustainability and social responsibility. And export would be one of the key sort of cornerstones of our growth in the coming years. They have been thus far. We do about 25% of our revenues from exports, but the endeavor is to widen this base and grow this bucket even further.
Thank you. On behalf of DAM Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you, everyone. Thank you.